May I please call the dignitaries up onto the stage? Jyoti ma'am, Rupa ma'am, Ranjan sir, Dr. Ashlesha. A warm welcome to all of you. This is our first public lecture from the Policy Lab, which is going to deal with finance, infrastructure, and governance. We are very proud to have hosted this today, and we hope that you will have a lot of takeaways from this session. I will not introduce Jyoti ma'am separately, but as you know, she's our esteemed director and she's the Dean of the Faculty of Humanities and Social Sciences. She will do her opening remarks, but before that, let me introduce Rupa ma'am to all of you. Dr. Rupa Rege Nitsure, a former group chief economist and group executive council member at L&T Finance, is currently serving as the professor of practice at SSE Pune. Before joining L&T Finance, she worked as the chief economist and general manager in Bank of Baroda, as the senior economist in ICICI DFI division and ICICI Bank. In her professional career in the banking and financial services sector, spanning more than 3.5 decades, Dr. Nitsure served on many important committees appointed by the Reserve Bank of India and the Government of India, and regularly published articles in the field of policy-oriented research in national and international journals. To name a select few, she was the member of the Standing Advisory Group on Indian Statistical Databases (RBI) between 2004 and 2007. Sorry. She was the member of the Committee for Integration of Banking Structures, Ministry of Finance, Government of India, around 2011. She was the member of the expert committee to revise and strengthen the monetary policy framework, Reserve Bank of India, chaired by then the Deputy Governor, Dr. Urjit Patel, between 2013 and 14. She's a regular commentator on economic and policy issues in the print and electronic media. There is a long list of roles and functions that she has undertaken. But her key areas of specialization have been macroeconomics and financial intermediation. Dr. Nitsure holds a MA, MPhil, and PhD from the Gokhale Institute of Politics and Economics, Pune. I have cut short the introduction, but it is a very impressive profile that Dr. Nitsure has. In the interest of time, you can check out her profile on the SSE website as well as her LinkedIn profile. Please gear yourself for a wonderful session that begins now. I would like to welcome Jyoti ma'am for her opening remarks now. Thank you.
A very good morning to one and all present here today, those offline, those online. A warm welcome to our first public lecture by none other than Dr. Rupa, a associate, a friend, somebody whom I brainstorm with whenever she comes to college. And, we sit together and get her monetary perspective, whereas I talk about my development perspective. So, Rupa, A warm welcome to you to Symbiosis School of Economics at this platform, your first public lecture. And I'm sure you will strengthen the finance department at both the BSc program and the MSc program. Within a short span, you've contributed very majorly with the macroeconomic perspective, which nudged me to come out with the director's insight each time. And so each month, I think of a new idea of how to talk, how to address the various stakeholders that the newsletter goes to. And this is all thanks to Rupa's initiative when we met offline. I remember at NIBM, at that point of time, we had this little conversation, and it's truly working out. For many of you who are from BS Economics, third year, I'd like to give you another special news. Um, you know that we have had a tie-up with Aston University and with Lancaster University, which got approved by the Academic Council for you to have a pathway program of 3.5 years. So next year, when you go to the seventh semester, after the seventh semester, those of you who have a CGPA of 7.5 and above and a MSc, I mean a BSc honors with research, will be able to graduate to Aston University directly, saving 6 months. And hopefully, we can even work out some kind of a discount with the two universities for you. So, this is a part of our internationalization. This is a part of our nationalization that Rupa is here to strengthen the academic curriculum. And, the day she came in, the first thing we did was share the curriculum with her. And she felt we were quite on track. Of course, curriculum always needs tweaking because the environment is so dynamic, and wonderful addition to the SSE family, strengthening our academic curriculum as well as research output at SSE. So moving today to a very favorite topic for us, and I'd like to welcome one special guest here who's come today to hear Rupa, Dr. Rajendra Kulkarni, sir. A warm welcome to you. And I have to share this with you, students. In 2017, when we were hosting our SDG conference, I had gone to Kulkarni, sir, in December 2016. All right. And at that point of time, we were talking about the SDG conference, maybe somewhere in 16. And he said, okay, why don't you give me a proposal for, why don't we work out on a rural infrastructure index for the state of Maharashtra? And that's exactly as soon as the SDG conference was over, Ranjan, myself, and and Varun was there, and a couple of other faculty got together and put a proposal for NABARD. And that was our first rural infrastructure index for the state of Maharashtra that was funded by NABARD. Thereafter, we have not looked back with our delivery with NABARD and NABARD's faith in us. So, sir, it has a lot to do with you giving us that first opportunity, and I'm so privileged that you're here today. So, Ranjan, please ensure that Dr. Kulkarni gets the hard copy of the Rural Infrastructure Index, that we did the second version of it, updated. And therefore, in infrastructure, we've been invested as economists because we feel that infrastructure has a great impact on the growth of a country. And as we graduate from a 4 trillion to a 5 trillion towards becoming an upper middle income category, the rate of change of investment in infrastructure and its impact on the economic growth can have its impact on the short term, long term, medium term. While we're doing well on certain infrastructure sectors, there are certain infrastructure sectors that do face challenges. And today, the question that comes to one's mind is India's financial sector capable of funding India's infrastructure requirement, as we are hungry for much more? And is that capacity there in the financial sector, in terms of credit, flows that can be there, the investment multiplier that emerges out of that kind of, emoluments put across, as well as the institutional adequacy and the instrumental adequacy, the depth and the width of the capital market which can fund the India's infrastructure requirement, as well as our capacity to borrow from the international market, from multilateral banks, etc., who are quite invested into an economy which has great, great potential to emerge in the years to come. It typically says, and we have miles to go before we sleep, because when we look at the infrastructure in our own cities, the inadequacy of the same stares in our face. And here, therefore, while we talked about a rural infrastructure index, we hope that at some point of time we can come up with a city development plan in terms of saying city economic plan, where you say what is the infrastructure requirement in the next 5-10 years. And if cities came out with that plan, we always feel cities are like firms. And cities, if they are efficient, then livability enhances. Livability enhances, it has its impact on productivity, and it goes on. I have loads to speak, but I won't stand between our key speaker for today, Dr. Rupa Nitsure. And Rupa, we are eager to hear you. And thank you, students, for being here. Please be a very, please pose all your questions. Maybe some of it can even become dissertation topics for you as you move on. Thank you so much. And once again, welcome. And now my sit down because of the process. Okay.
त्या मोडवर आणायला त्या मोड good. Good morning. Thank you, Dr. Ishita, Professor Jyoti, for the kind introduction. Distinguished guests, students, and of course, my dear faculty members, it's a pleasure to be here today at the first, inaugural event of the Finance Policy Research Lab of Symbiosis School of Economics. My special thanks to Professor Jyoti and to Dr. Ashlesha Khedekar for undertaking this novel initiative. Today's topic, challenges in infrastructure financing, is highly relevant for India. Infrastructure assets, basically the transport networks, utilities, social infrastructure, they deliver public service, and they are very complex in nature, and they are long term. So, it is for their sustainability and the stability of the infrastructure development for any nation, we need financial structures, and we also need a commitment from all types of stakeholders. And by that, I mean the governments, central government, state governments, union territories, urban local bodies, etc., financial intermediaries, that is primarily banks and infrastructure financing, NBFCs, developers, promoters, and of course, other stakeholders who understand the short-term and long-term risks associated with infrastructure development. So for the stability, sustainability of this sector, a strong commitment from all these stakeholders is required. So let me start with Indian story on infrastructure development. We know India's infrastructure ambitions are quite large. We aspire to transform ourselves into a $30 trillion economy by 2047. Can anybody tell me what is the size of Indian economy today in dollar terms at the end of March 2025? It was 4 trillion. So from 4 trillion to 30 trillion, we want to achieve that kind of transformation by 2047, build 100 smart cities, and ensure seamless connectivity across urban and rural areas. We have been seeing since the COVID pandemic happened, it's the government's, the central government's infrastructure push that has been used, as the major stimulus to act, to restart the economic engine through multiplier accelerator effect. And there has been a substantial increase in public investment, that is the fixed capital expenditure, CapEx, from rupees 4.1 trillion in FY21, that is the COVID year, and now 11.2 trillion as budgeted in FY26. So this reflects almost 3 times increase in the past 5 years. And this is just the capex. If you add to that the grants in aid also, then we have increased from 4.5 trillion to 15.5 trillion in just last 5 years. This is a huge push given by India's central government. More telling has been the increase in this capex as percentage of India's GDP, which has more than tripled from mere 1% in FY14 to now 4.3% in FY26. But what we have been seeing is that the key drivers, the key recipients of these funds have been roads, railways, and power sector. They have been given a prominent role in government's capital spending, and they are expected to attract more investment in the foreseeable future. Traditional growth drivers for infrastructure in India, that is roads and railways, have made way for some additions in recent years, and those are power generation, within that renewable energy power generation, and urban infrastructure. Now, various initiatives have been launched by India's central government to give push to infrastructure development. What are these? You must have read about it in the newspapers or heard on TV channels or studied in your Indian economy syllabus. First is National Infrastructure Pipeline. This was launched with a forward-looking approach and as a centralized platform for hosting projects of states, union territories, and central ministries. Currently, there are over 9,766 projects and schemes across 37 subsectors. Then second was National Monetization Pipeline, whereby, the government's core assets were monetized. And this initiative was taken by Niti Aayog to give a roadmap for monetizing government-owned assets to fund new infrastructure projects. So between FY22 and FY24, transactions worth rupees 3.86 trillion were completed in core asset monetization. Another project was Gati Shakti. This project was launched to provide seamless and efficient connectivity for the movement of people, goods, and services across various modes of transport, thereby enhancing last mile connectivity and reducing travel time. So here the ambition was quite large, where urban as well as the rural zones were considered in totality. Then there was Bharatmala project, which was a highway development program in India, which included the development of economic corridors, inter-corridors, and feeder routes. And this program focused on providing connectivity to rural and far-flung border areas. And also there was this Jala Jeevan Mission. These are all mega projects. There are many small projects, but I have listed here all mega projects. This program aimed to provide every rural household in India with tap water by 2024. I don't know how much of that is actually achieved, but this mission definitely improved access to safe drinking water in many rural belts, particularly in regions affected by water quality issues. But despite such humongous and earnest efforts, there is still a significant unmet demand for infrastructure development in India. The goals set for the year 2047 are constrained because of a significant infrastructure financing gap. The World Bank's latest study shows that India's infrastructure financing gap exceeds 5% of its GDP at present. And institutional investors, the long-term investors like insurance, pension funds, etc., they allocate only 6% of their funds to Indian infrastructure. See, if you compare it with other East Asian countries, especially China, you'll see there the percentages are as high as 25-30%. In India, it is only 6%. You know the problems, long gestation periods, high capital requirements, they deter lenders. exacerbating the financing gap. So without greater private sector involvement, the country's grand vision may fall short. Now, this diagram is very telling. This is private sector's contribution to gross fixed capital formation of the country. This is private sector's gross fixed capital formation, means how much of the capital investment India's private sector is making. The blue part shows their actual investment on infrastructure projects. And the rust color shows, the orange color shows non-infra projects. So that is the level of private sector spending on infrastructure. See, certain things, when I say numbers, it's not clear, the proportions. When you see in the graphical forms, you can see. So this is how private sector is shying away from undertaking infrastructure investment. Now, why private sector is reluctant to undertake infrastructure projects? At present, 3/4 of the spending on infrastructure in India comes from the government sector. Usual reasons: lumpy capital investment, they require huge funds, long payback periods, and difficulties in mobilizing large equity and debt at affordable cost. They pose significant challenges for the private sector participation. There are project structuring issues such as risk estimation, allocation, mitigation. All these things further complicate their participation. Then major thing, the real sector problems. Delays in obtaining clearances and land acquisition processes, because India still suffers from license raj and red tapeism. So those also pose considerable hurdles. But major thing is that there is no independent regulator for infrastructure sectors. Reserve Bank of India is a regulator for banks and financial intermediaries, NBFCs, cooperative banks. SEBI for stock markets. We have insurance regulator, IRDA, etc. But we don't have an independent regulator for infrastructure sectors, and that adds to the difficulty. There are contractual issues and inadequate arrangements for dispute resolution, and arbitration leads to prolonged litigations. That also discourages private sector's infrastructure investment. You are young people, but some of the senior people may know that how India suffered from policy paralysis between 2011 to almost 2018-19. Because of very high NPLs in banking sector on their infrastructure loans. In India's history, it's not that private sector participation in infrastructure development was always limited. It has been actually patchy. If you see the period between 2008 and 2011, it boomed. But with that policy paralysis phase that started in 2011, and with banks gross NPA reaching the high of 9.5 to 10.5% by the end of FY 2017, private investment in infrastructure started receding. And then, in India, we had development finance institutions like IDBI, ICICI, IFCI, who actually were created to generate developmental finance. And infrastructure development, the finance required for infrastructure development, comes under development finance because of the characteristics which I mentioned earlier: lumpy capital investment, long payback period, etc., etc. But in early 2000, regulators took a view that the role of DFIs in Indian economies is extinct, and banks can very well undertake that function and support infrastructure financing. Unfortunately, that didn't happen, because earlier, before when DFIs and banks existed, there was a very clear segmentations. DFIs used to lend for project finance, long projects, and banks were giving primarily working capital finance. So banks didn't have capabilities or skills to undertake long-term projects or project finance. And it cannot be, that specialization cannot be developed overnight. And we have seen the pitfalls of that, many negative ramifications of that decision. And now we have come back full circle to creation of a DFI, because now we are facing that dearth, and we are saying. So in 2021, Indian government set up NABFID, National Bank for Financing Infrastructure and Development, to take care of the infra financing gap. But this institution could not build portfolio of even 8% of the target assigned to it. Because when we did away with DFIs, we lost the full culture of project finance. See, when you, it's very easy to close down the institutes, but to, restart that culture is a very, very complex task. So even if this institution is created, it could not build portfolio of even 8% of the target assigned to it. Also, it is not clear whether it has extended new finance or refinanced the old projects, and it does not disclose information about its portfolio. So there is a lot of haziness about the actual funding, the financing to infrastructure undertaken by National Bank for Financing Infrastructure and Development. Now I would come to construction and real estate sectors, because construction and real estate sectors also is a very important, or rather infrastructure is a very important component of construction and real estate, because construction industry has three components. One is building construction, whereby they build residential, commercial, institutional, healthcare buildings. Then infrastructure construction, roads, railways, metros, depots, dams, airports, etc. And then industrial manufacturing construction, where plants, factories, etc. Now, if you see, the major driver of construction industry has also been the infrastructure in India. If you look at the last 3-4 years data, you will see the maximum spending of the construction sector has been made on infrastructure projects. So a lot of activity is happening, but it is not matching with our aspirations. So as per the CRISIL report, construction investments are expected to grow by nearly 1.6 times between FY24 and FY28 compared to fiscals 2019 to 2023. And this is a, post-COVID period. Still, today, if you talk about development, the major development that is getting reflected is in construction projects. Growth in construction sector is expected to be propelled again by the infrastructure segment over the medium to long term, as building construction and industrial construction are likely to record sedate growth rates. And now with all this Trump tariff, turbulence, uncertainty for the manufacturing sector, especially the export-oriented sectors, we are not expecting very high growth rates in private capex in the manufacturing sector. So again, the major growth driver for construction industry will be infrastructure projects. Central government's focus on roads, urban infrastructure and railways will boost infrastructure investments in the coming years. Contribution of construction industry in India's overall gross value added of the country has been very high. It has ranged between 7.9 to 9.1%. So on the back of strong government support through various initiatives such as dedicated freight corridor, Bharatmala, Sagarmala, smart cities, Pradhan Mantri Awas Yojana, that is affordable housing scheme, the GVA of construction industry in absolute terms at constant prices has grown to rupees 14.38 trillion in FY24 from just 8 trillion in FY14. In 10 years, it has registered a compound average growth rate of 6%. But there are many challenges. If you talk to real estate developers, they will, you'll come to know the challenges faced by them. First is the regulatory landscape, because they have to, try for multitude of permits, approvals, and compliance requirements. It could be a very tortuous process. There are funding dilemmas. Access to finance remains a perennial challenge for builders, especially smaller and mid-sized players. Elevated interest rates, because very high risk premium are loaded in the lending rates on loans extended to them. And RBI also has assigned very high risk weights to commercial real estate projects, so that increases the cost of borrowing. So these elevated cost of borrowing coupled with stringent lending criteria, they impede the progress of real estate projects. Then India's usual problem of project delays. The specter of project delays looms large in the Indian real estate landscape because of regulatory hurdles, land acquisition issues, bureaucratic bottlenecks, because they all contribute to extended project timelines. Builders and property owners find themselves grappling with unforeseen delays, leading to increased cost and potential loss of investor confidence. And we had seen that post COVID. Earlier I was told we had, India had something like, many real developers in many thousands. That number was consolidated to just 65 post COVID. So, that kind of takeovers have happened by larger builder of smaller builders. Lot of, I don't want to name the companies, but they could not complete their projects because of lack of funds. It has happened in Mumbai, it has happened in Pune, in all, uh, major metros. But consumer expectations are also evolving because India has a very unequal society. So the top, 5 to 10 percentile people, they have very, ambitious, strong aspirations, and they are more discerning and well informed. So staying attuned with market trends and adopting innovative construction design approaches, they are, that also poses a hurdle in gaining competitive strength in this ever evolving landscape. Other thing is, of course, sustainability, because now emphasis on eco-friendly practices is growing globally, and we are no exception to that. Builders are now challenged to integrate green technologies, energy efficient designs, and sustainable practices into their projects. So this again requires additional funds and a shift in the mindset within the industry. Technology. In an era where technology is reshaping industries, real estate in India faces the challenge of embracing digital transformation fully. So from adopting advanced project management tools to, leveraging virtual reality for property showcasing, builders need to keep pace with technological advancements. And the most important factor is market volatility. Real estate market is inherently sensitive to economic fluctuations, business cycles, which impact property prices, demand, funding availability, and the overall industry stability. So diversifying portfolios, staying agile, and anticipating market trends are crucial strategies for mitigating the impact of economic uncertainties. And that is the reason why the number of developers has fallen from many thousand to just 65 post-COVID, because post-COVID was a real sector crisis. Though it originated from health sector, it had pushed the global economy into a coma state. That has not happened earlier, not even during the world wars. No economy had gone into a complete coma state. But COVID gave us that experience, and the sector which was badly impacted by COVID pandemic is actually the real estate sector. So in recent times, unconventional funding sources like private equity, IPOs, alternative investment funds, AIFs, they have gained prominence besides the bank borrowings for developers, because now lenders have become very risk averse when it comes to lending to support and sustain those growth rates. So even by increasing the private participation by 10%, the opportunity for private investment infrastructure widens to US $324 billion, amounting to an average annual US $54 billion until 2030. While this looks formidable, similar larger investments are undertaken by our peer economies. So what lessons we can learn from our Asian peers? That is very important. So these are some of the recommendations which I would like to make to revive private sector sentiment. First, to speed up the implementation of infrastructure projects, there is a need to strengthen single window clearance in India. In 2021, India introduced National Single Window System, which integrates various clearance systems from central and the state government into a unified digital platform. And this system aims to provide end-to-end facilitation, etc. But to improve its functioning further, we can learn lessons from Singapore, like setting clear and predictable timelines for various agencies, fast-tracking environmental approvals, and a more transparent and efficient land acquisition framework by reducing litigation time and compensating quickly to expedite the process. Improved coordination between government agencies and the use of technology in project management. Singapore has embraced building information modeling and other digital tools to streamline the design and approval process. The BIM, building information modeling, enables coordination between agencies and minimizes delays caused by rework or conflicting requirements. So there is tremendous potential for deployment of digital technology to improve coordination amongst different stakeholders, which has not happened in India. Provision of sovereign guarantee. Sovereign guarantees protect private investors against political, regulatory, revenue, and demand risks, ensuring a minimum return on their investments. This risk mitigation leads to improved financing terms such as lower interest rates, longer tenures, and attract institutional investors who might otherwise be hesitant. So, peer economies such as Indonesia have successfully used sovereign guarantees to attract private investments into infrastructure through mechanisms such as Indonesia Infrastructure Guarantee Fund. The fund provides guarantees for various regulatory risks such as contract risks, changes in laws and regulation, delays in project clearance, and approval. So we have to see how our trading partners, how our peer economies have tried to resolve the issues for them, because these are very common issues. Other recommendations are innovative mechanisms of financing. International experience shows how initiatives, at the state and local levels can facilitate resource mobilization for infrastructure development. Some successful examples include pooled finance mechanisms for municipal projects as adopted by various states in the United States. Some countries have adopted approaches such as, tax increment financing, land sales, development rights, etc. Another thing for which, we are struggling for very long is deepening of infrastructure bond market, because that alone will facilitate diversification from banks into a developed bond market, because those who are focused on the long term can reduce the burden on government finances by attracting private investment. So expanding the bond market can improve liquidity and attract a broader range of investors, including institutional and retail investors. You might have heard of 1997-98 Asian crisis. The crisis faced by all Asian miracle economies, because they were doing very well in terms of growth. But then they had gone ahead with capital account convertibility when their exchange rate system was still fixed, was not flexible. Their fiscal deficits were very high, and then there was a collapse. So the first reform in the financial sector, because that time the major victim of that whole crisis was the banking industry in these countries. So the first reform they undertook was to develop the corporate bond market, and that is how they reduced the dependence on banking industry. And today you see, in India, even when somebody is trying to raise funds through infrastructure bonds, who are the major subscriber to that? Banks and mutual funds. So indirectly, banks are taking exposure even to infrastructure bond. Why? Because the retailization has not happened. So any market can deepen and become liquid if we improve the retail participation in those markets. India has made a beginning by deepening municipal bond market. SEBI has been actively promoting municipal bonds as urban local bodies as a strategic tool to finance urban infrastructure. I think Indore Municipal Corporation, was the first municipality who raised it. And, they are preferred because they are typically backed by at least 4 to 5 credit enhancement layers. So no municipal bond issued since 2015 has defaulted to debt, but we still don't have a secondary market for municipal bonds, and that is, restricting the liquidity in this instrument. Another thing is widening infrastructure investment trusts in InvITs. Currently, InvITs in India are in the early stage, having raised US dollar 13.25 billion, that is rupees 1,100 billion, via equity. Fundamental features of InvITs such as cap on leverage, mandatory distribution of 90% cash flow, and limit on proportion of under construction assets benefits both investors and financiers. So these are some of the innovations that have happened in infrastructure financing. And then leveraging untapped financial products. While various financial vehicles can raise funds for infrastructure projects, many large capital holders, such as insurance and pension funds, are not significantly rooted into infrastructure development in India. And that is a huge corpus. So this underutilization represents a missed opportunity for leveraging substantial capital for essential infrastructure growth. With clear regulations and written guarantees, pension funds in India have massive potential to be rooted into India's infrastructure development. Then alternative investment funds, AIFs. They are a category of investment vehicles that differ from traditional mutual funds and stocks. They provide investors with opportunities for diversification, potentially higher returns, and access to asset classes that may not be readily available through traditional investments. So, despite its attractiveness, the AIFs in India are yet to reach its full potential because of entry barriers, wherein the minimum investment of US dollar or rupees 10 million, then stringent regulations, lack of awareness, etc., has limited the scope of this. But this has huge potential, this instrument. And then strengthening, again coming back to square one, strengthening of infrastructure financing institutions, because this would enable the credit enhancement specific to infrastructure projects. Some of the existing agencies that provide long-term financing for infrastructure projects in India, they include India Infrastructure Finance Company, National Bank for Financing Infrastructure and Development, National Investment and Infrastructure Fund, Infrastructure Development Finance Company. So we have many institutes, but the funds are not forthcoming to the extent required. So future policy reforms in India should be aimed at reviving private investments and attract foreign capital in India's infrastructure development. While there is adequate existing support by the government, there is still a need to augment key processes of infrastructure projects such as speedy approvals, enhancement of long-term capital, mitigate the project risks through government support to attract private participation in infrastructure development in India. So if we have to achieve our dream of joining the class of developed economies by 2047, we have to focus exclusively and in a committed fashion on infrastructure development. And we will be able to achieve our aspirations if and only if we manage to reduce our excessive dependence on government funds, because it is now leading to very serious fiscal situation, fiscal viability situation for the country. And unless the private participation in infrastructure projects gets revived, we cannot achieve our dream. Thank you. So now I will open it for questions. I just
PhD. So my question is about the lucrative sector, as we all know. However, with the government's push for more alternative sources of energy, renewable energy sources, do you think that government issued carbon bonds can help enhance these investments and increase private sector investments in alternative sources?
No, definitely. But see, major problem in India is the policy flip-flops. Because for renewable energy projects, if you take solar energy, you know, they suddenly increased, 2, 3 years ago, the customs duty on solar panels, which, threw out of gear the cash flow analysis for solar power projects. So, our this whole emphasis on Atmanirbharata or self-reliance, you see, it has to be a long-term objective, but you cannot achieve that overnight. But today our entrepreneurs were importing that stuff from, say, China, primarily from China, and then Malaysia, etc. They were very cost competitive. Now, suddenly, when you have raised the tariffs on that, they have become non-competitive. The prices have risen. So, if you see, compared to the targets assigned by the government for achieving a particular level of renewable energy, our actual achievements are very poor. 4, 5 gigawatts is nothing. I mean, China used to have this number in 40, 50 per year. So point is that we see for businesses, predictable investment environment is a must. And government should support that, you know. The government should not undertake any measure which will upset their cash flow analysis for in the coming years.
Uh, yeah, good morning, ma'am. So you were talking about how there is a lack of private expenditure within creation of these infrastructure projects. And in the graph that you showed, I saw there was a particular dip around 2016-17 area from the private sector in infrastructure comparative to non-infrastructure projects. I think around that time is when we had the ILFS crisis. So regarding that, the ILFS crisis was largely a part of infrastructure itself, which caused a lot of infrastructure projects to dry up. Isn't it not true? Because of the fact that it was one of the major investors in infrastructure, like it was a shadow bank that was like sort of providing financing for so many places. And even with the regulations that were at the time, a lot of checks and balances could not prevent this company from effectively, I should say, rug pulling the investors because they didn't audit themselves properly. You're talking about how you want to reduce regulation, right? But then in India, the situation is such that this volatility is occurring even in situations where you have companies working within the regulation. So how do you think we can sort of create that stable environment that you're talking about where you can have assured investments in these infrastructure projects?
Yeah, see, your question is very pertinent, but let me correct you on one point. It was not the ILFS crisis that was the starting point of slowdown in infrastructure projects. Slowdown had happened much before that, and it was triggered by the policy paralysis when all those corruption scandals were breaking out, and bureaucrats were not taking decisions, not giving approvals. There was a complete paralysis. Lenders, because what had happened after global financial crisis, uh, you know, banks were asked, there was a moral suasion of banks to lend more to infrastructure projects because we wanted our growth not to suffer because of the global financial crisis. And that time, you see, any point of time when there is a force factor to lend, it always leads to some moral hazard issues, and the credit underwriting suffers. So the culmination of all these problems, it saw its reflection in very high non-performing assets in infrastructure projects of banking industry. After that, they were focusing on cleansing of the balance sheet. So they were focusing more on lending short term rather than giving long term loans and all. ILFS crisis was a governance crisis. And after that, actually, if you see, the Reserve Bank of India tightened regulations from asset side for all upper led and middle led NBFCs. So these two are different issues. Private sector today is shying away because, first of all, there is a dearth of funds. Secondly, the risk which you have to take on your books is very high. It's very complex, and there are policy flip flops. For instance, suppose you have undertaken an infrastructure project in say road sector, and suddenly if there is a change of the government, at the state level, and if they bring out newer regulations, this because during policy paralysis period, I remember many of our road projects, they got stalled even at the stage of 95-96% of completion. After that they were stalled. So actually, that time I remember Dr. Raghuram Rajan was the governor, and in our pre-policy consultative meetings, we used to tell him and the RBI officials that we should make effort to save national assets, because nothing had gone wrong with those projects per se. It was not developers' mistake, but because they were not getting approvals from the government on time, the projects were not, they were stalled. So it's a job that has to be done in partnership. That's why I said it requires not just financial structures, but commitment from all stakeholders, the government, the financial institution, developer, and of course people, the risk analysts, you understand the complexities of risk management.
Thank you for your insight, ma'am. Okay, can you pass?
Hello, ma'am. My name is Prasanna Muruskar. I belong from MSc first year. And first of all, thank you for such an high horizon, insightful session. I have a related question, and I expect your professional opinion based answer for this. What I wanted to ask is that since we have a low amount of investment from the private sector, so is there any risk like risk management framework problem, or is there any lacuna in it, or any need to be development that should be done so that more private uh, investment is there?
No, that is a major precondition. Means, unless somebody understand the risk of investment, uh, they won't be able to, contribute to that project. But as I said earlier, for to stimulate private investment into this project, the government can support by keeping the policy environment more steady and predictable. Also, that's why I use the term policy flip-flop. Sudden increase in tariff barriers, or sudden banning of exports of certain categories, or sudden banning of future trading, derivatives trading. This kind of uncertainty can give rise to lack of, whatever the investment appetite for the private sector. That is one thing. But secondly, also, they will go by their past experience. And the past experience is always the predictor for future. That's why I say their investment, not that investment was always very low. There was a period until 2013 when they were contributing 46-47% to infrastructure projects. In a decade after that, it has fallen to 7%. Why? You see the problem in the infrastructure projects during that period. Right. So policy paralysis actually was a very bad disease, which has, it really victimized the infrastructure sectors in India.
I'm just one question I would like to
Sure,
add up.
sure.
Compared to other countries that have a good amount of financing from the private sector, is there any parameter that can be enacted in our policies that would kind of boost up this process, or is it?
No, that's why I gave those points of single
Yeah.
window clearance. There are many best practices
Yes.
which we can emulate and adopt in our country. But one thing we also have to understand that India is a very diverse country.
Correct.
And, we have, it's very difficult for a large size democracy with so much of diversity to manage, issues like land acquisition, and these are very politically sensitive issues. So, ours is, I always feel ours is like European Union. We have certain states which resemble Greece, and there are certain states which resemble France and Germany. And that's why we see this huge gap in infrastructure development, say within southern states and northern states. So even within India, we can learn from each other, and there is a scope. If there is no dearth of knowledge or expertise or idea. But the major problem with India is execution. We are not able to complete our projects on time. Anybody who has worked in a development financial institute can tell you what used to be the cost and time overruns uh, for various infrastructure projects. So we have to manage that, and that becomes very tough in argumentative democratic country. That's why Amartya Sen calls us argumentative Indian. So execution challenge is the major. There are so many books on this, how execution happens in China and how it doesn't happen. Which country of the world set up first special economic zone for export? Not China, India. We had that vision, but see today where they have gone and where we are. So everything has to do with execution. Yes, ma'am.
Thank you so much, ma'am.
Hi, ma'am. Good morning. My name is Makarand Joshi. Thank you for the session. Makarand Joshi. One question is there. Do you think that if the government spends a large amount of money also on the R&D for doing quicker infrastructure development, because generally we hold that more amount of research has been taken, and more importantly, can we just work out on I don't know, but for any infrastructure projects, if there's an import we have to do for certain raw materials, something, if those dependencies can be reduced, because even private investment can always increase if the risk gets lowered down. So do you think that this can help?
It will certainly help, but it will not give us quick results.
Okay.
Because if you look at the post-independence history of India, the spending on research and development by both the government sector as well as the private corporate sector is one of the lowest.
Right.
If you make a global comparison.
Correct.
If you even countries like Bangladesh, Vietnam, their manufacturing industries have higher spending on research and development than in India. We focus primarily on the services sector.
Service sector.
For job creation, for exports, etc., which actually has not helped development of our manufacturing.
But presently, does the government has some sort of an investment on the R&D for
The
infrastructure?
point is that this
Sorry.
is not the time when they will be
Okay.
able to do it, because as I told you, the general government debt, the public debt to GDP ratio is already 82%.
Correct.
So our sovereign rating and everything depends on how we manage our fiscal position.
Oh, one more just question. Does institutions like HUTCO and SITCO in the state government, do we call them as infrastructure supporting bodies also? I'm just asking. HUTCO does support for infrastructure development, right? They are not. Okay, the name was not that. That's why I asked. All right. All right. Okay. Okay. Thank you. Thank you.
Hello. So my question was, when we're talking about reviving private sector sentiment in infrastructure and real estate, would redevelopment be an attractive thing for private sector when it comes to returns? And what would be the trade-off between, let's say, investing in redevelopment versus investing in a greenfield project?
Well, redevelopment has gained a lot of momentum, but there are many issues associated with that because it has become a very easy source of making quick money. But I feel that, focusing on green technologies and green projects, that has to be given priority because here, if the local regulators, the urban local bodies and their governance and how they are regulating this particular activity plays a major role. So, from the sustainable development perspective, I think green projects and green technologies have to be given prominence. Thank you.
Um, Hi, ma'am. My question was about the L1 reforms. I wanted to know what your opinion would be on the last round of L1 reforms, and do you think that has done anything to speed up all kinds of government procurement that's required in infrastructure projects? And by extension, I also mean to ask, uh, are we doing a good job accounting for the negative externalities that bureaucracy causes in procurement and its impact on infrastructure?
Actually, your question has given answers. That is the real problem in the course of infrastructure development. And if you remember my slides, I have mentioned this as the bureaucratic hurdles and all, and that is a disease actually in India. And about L1 reforms also, I would say that you see, the primary thing is investment appetite. But these reforms are not enough to improve the investment appetite in these projects. People will go by their past experience and their rational expectations are formed based on what they have experienced vis-a-vis various government agencies. So it requires a major overhaul. There's no doubt about it.
The new way in which they are dividing importance between quality and cost, those are the new reforms, as far as I know, that now both quality and cost will be given a priority while choosing a bidder. So do you think that's
But
not been enough?
process has to be transparent. The process has to be consistent. In letter and spirit, everything looks good. That's why I said our major problem is execution and implementation. And in infrastructure sector, that is the major story. Yeah.
Hello. Yeah, thanks for a very illuminating lecture. And you have touched upon the various financing issues which have kind of impeded infrastructure development. I think one issue which was perhaps missing is the emergence of mezzanine financing. Because the issue really was what was contemplated when the Dr. Rakesh Mohan committee report was kind of taken up in 1995 was that there would be a set of players who would kind of emerge in the economy for taking up the project risk during its implementation stage. And then we would have a set of players who would emerge and take up the subsequent period of financing of the infrastructure projects which needed to be there. The other issue perhaps has been the lack of the state governments kind of coming together and giving in on the stamp duty issue for the emergence of a secondary, bond market for corporate bonds, infrastructure bonds, whatever you call it. Your views.
Yeah. No, no, no. This is a very important point, and I should have mentioned it. But I think they have taken care of exactly this point by developing the municipal bond market. And that's why I said they have built those 4, 5 layers of credit enhancement. It is exactly at that stage, at the implementation stage, how the different party will come. But yes, point is that I think that's why I said that there was no dearth of ideas, good ideas. Actually, Rakesh committee report was very path breaking, and it had come at a point where, if all those suggestions, if we had taken seriously, things would have been different. But point is that our journey remained half-hearted because somewhere there was these expectations that there will be a smooth transfer of this expertise from development finance institutes to banks. And then there was a monopoly of 2, 3 institutes who undertook for the entire banking industry the project viability, the technical viability studies, etc. Unlike in our old institutes where we have worked together, we had such well developed specialization for project finance, and the financial viability analysis will be done by finance expert, technical viability by engineers, and social cost benefit analysis by economists using those little mirrors technique. That whole expertise and culture was lost, and after that I couldn't see that kind of, because there, even though that time the Apex Institute was IDBI, we had specializations within different DFIs. We completely lost them actually. And then the monopoly of 1 or 2 institutes, it didn't serve the sector. So that kind of layering didn't happen actually. Exactly. Yes. Yeah. Actually, ICICI was lucky because it at least became a bank. But even for IDBI, I felt there were many hurdles in that journey, which created that whole conversion, a very toxic kind of experience for them. Government supported bonds. Their bonds were given the status of sovereign bond status. Yeah. So they could be used for SLR by banks, etc. Yeah, sir. Yeah, sure, sir. Yeah.
Ask. And in any case, this is a very highly layered kind of a subject, infrastructure finance. And it's very difficult to cover it in 1 hour. So, but I appreciate you've covered. There's one segment which I thought that I should bring it to the notice of them also and maybe have your views. And as a practitioner, I have found it very relevant, was the maintenance of the created infrastructure.
Yes.
Because, this is something, depending upon what we have created, it leaves a string of projects if unattended to or less maintained. And that becomes a multiple. I mean, it's a huge problem for the government or whoever or the investor. Now, this is a hard finance issue, as also because there are methods by which it can be incorporated in the original project cost itself. But that raises the cost of finance, like what you have showed here. If I'm not very sure, I know the state funded projects maintenance cost is not included in the projects.
Oh.
Now, in private finance, if this is already included, then perhaps, I stand corrected. But even then, who takes, the question is who takes that maintenance? And that's where, it's all a related kind of an issue where you gradually move into other, realms like, the hard economics realms as who benefits and who pays, especially in the context of, this cost overruns and time overruns. The one who pays and the one who benefits, they could be completely different. So I think maintenance was something which, I personally would like to be, if you can. I mean, in a short time. Thanks.
Yeah. I'm sorry I couldn't, because you have given me a new perspective. I didn't think from that perspective at all. But yes, just to give an example, that now they have made it compulsory for different residential societies to have solar power generation. And I personally feel that, there the arrangement looks fair, because initially you undertake pay for that, but then later the maintenance remains the moral responsibility of the users. So it has to be like that. As long as transparently, when this burden is not given to people who actually are benefiting out of that, it's not sustainable, and that happens. Yes. Exactly. Yes. Yes, yes, yes. No, I don't think they have added that. It's not done because first of all, the projects are only not getting completed. Forget about it. That's at a much later stage. Yes, 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 yes. No, your points are very, very deep and very profound, but we are stuck at a very different stage. Yeah. You wanted to say something. Okay. So can I? Yes. Thank you.
Okay, at the end of this event, so I have the duty to extend or provide my vote of thanks. So, good morning, everyone. It has been such an honor to listen very good lecture on this project, let's say infrastructure financing. And I remember my graduation days, right? So my teacher used to say India is a developing economy, right? And I completed also with India is a developing economy. Now also I'm teaching India is a developing economy, right? So I don't know when we will be called as developed economy, right? To be developed economy, we need infrastructure, right? And we are way short of this, and lot of challenges are there, and maintenance is one of the challenges. I think recently there is one verdict by high court on the road conditions, right? If the road conditions are not good, the government is not entitled to collect toll tax. So these are the issues are there. I'm sure some of the students will take up these issues in their study and let's say dissertations. Okay, let me start with the on behalf of SSE. I would like to extend my heartfelt gratitude to our speaker today, Dr. Rupa Nitsekar. And thank you, ma'am, for enlightening us about the infrastructure financing and different challenges on this aspect, right? So one of the major challenges remain the bond market. So far, we have not able to develop the bond market, which is critical for infrastructure financing. Sincere thanks to our director and Auslesa ma'am for, let's say, floating this idea of research lab. And this is the first activity of public lecture, many more to follow. I hope also Rupa ma'am to deliver many more lecture on this issue also. Also, I would like to thank all the faculties, those have been involved on organizing these events, right? Okay, my sincere thank to non-teaching staffs, IT staffs for organizing all these events. There's a lot of backup support, infrastructure requirement also for conducting this kind of supports. And also our audience, teachers and other distinguished audience, those have joined with us. Thank you so much for sparing your time and joining us.